G'day, Scotty here. Who had Australian unemployment sitting beneath 4% heading into Christmas? Because that is the reality we're looking at right now, and it should be celebrated. Another bumper November jobs report. Unemployment down to 3.9%, down from 4.1%. Markets were looking for 4.2%. And remembering, of course, the RBA expects over the entirety of the December quarter for unemployment to average 4.3%. So it's already 0.4 of a percentage point beneath what the RBA's average was looking for in the December quarter. Big increase in employment coming through, over 50,000 gain in full-time workers. And when you look at those parts of the labour market that are very sensitive to changes in economic conditions, it's becoming increasingly clear that it looks like unemployment has peaked. And if that is correct, it begs the question, should the RBA be cutting rates in the near term? Here's what I'm talking about, and this is what the RBA has been pointing to themselves when it comes to the statement of monetary policy statement, press conference from Michelle Bullock, and the like. Some of the indicators that are more sensitive to shifts in the economy are all starting to go and re-strengthen again. Underutilisation rate, underemployment, and unemployment is now rolling over 10% and sitting at levels not seen in around about 18 months or so. The youth unemployment rate, it's down more than a full percentage point from the recent highs. And the underemployment rate, which for simplicity's purposes is essentially the proportion of the employed workforce who would like to go and work more hours but can't, is sitting just 0.2 above the nadir that we saw back in 2022. So not only are these levels beneath what we saw before the pandemic arrived, but they're now moving back towards the levels that we saw when the labour market was the most tight. And looking at these areas that typically move ahead of what's going on when it comes to the broader unemployment rate, well, it looks pretty clear right now, just given some of the trends, that unemployment has already peaked this cycle. It's not a guarantee, of course, but when you look at what's been happening, both in seasonally adjusted and trend terms, it's rolling over. Now, it's interesting to see how the markets have interpreted this because, of course, we saw that dovish shift coming through from the RBA earlier this week, dropping some of the concerns about upside risk to inflationary pressures, and automatically have latched onto the idea, well, no, the pivot means that the RBA is moving towards a February rate cut. That might be so, but it comes across as a little bit preemptive. Now, this is what the current pricing looks like according to swaps markets. Right now, before the data came out, the February meeting had around about 72% probability of a 25 basis point cut coming through. That's been whittled away now to around about 58%. So it's come down a little bit, but not a lot. And more broadly, over the next 12 months or so, we still have 3.5 cuts priced into the curve, the OIS curve, which is almost identical to what we saw before the data, which is pretty remarkable considering the signals that we've got in so many parts of the labour force survey. Now, I understand why some out there, including on social media, are talking about the potential that Australia's labour market can now go and run an unemployment rate far lower than what was historically the case and not generate wage pressures. You can see that in some of the information that's coming through of late. Have a look at what's going on when it comes to wage growth. This is the annual change in the ABS wage price index. You can see it from 4.2%. It's come off the boil, around about 3.5% or so. So it looks like it's peaked, and it feeds into that narrative that maybe, hey, the wage pressures that would normally be associated with an unemployment rate of 3.9% aren't the same as what they were in the past. There's been a change in the way that the economy functions. When you look at other things as well, the trimmed mean inflation rate, which we know is the RBA's preferred measure. This is on a quarterly basis here, and you can see from 1.8% back in the third quarter of 2022, we're now down to 0.8. Now, that's not going to get us to the midpoint of the RBA's target, but you can see the overall trend is that it's coming lower. So you have disinflationary forces in wages, you have disinflationary forces coming through in underlying inflation. So that bolsters the case from those out there that potentially what we're looking at right now is that there's been a structural change in the economy. Unemployment can now be far lower than the past without generating wage pressures. They may end up being correct. But all I do is look right now is what's going on in other parts of the developed world where we've not seen a massive deterioration in the labour force. And naturally, you come back to what's been going on in the United States and look at what's been going with the trends there. Unemployment sitting at 4.2%. Hasn't really gone back to the levels that the Fed was looking for, or many out there expected to go and see. And as we saw in the inflation report that came out overnight, again, another 0.3 for the core reading. That's 4 in a row. Annualize that out, 3.6%. Yes, it's not the Fed's preferred inflation measure, but it looks like we're now bottoming out at levels well above what the mandate is. And I can't help but looking at that and think, well, the US economy, whilst it's completely different in its structure to how we operate in Australia, you can't go and look at that and see when you've still got relatively tight labour market conditions and what the message is coming through when it comes to inflationary pressures. The US economy opened up way before Australia as well. So it's giving you, in my opinion, a bit of lead indicator as to what we could potentially expect. And you look at some of the other readings from the United States last night when it comes to the details of that inflation report. You know, the supercore number, again, well and truly above acceptable levels on a monthly and annualized basis. When you look at some of the core goods readings, which the disinflationary forces that were coming through, they too now are starting to go and pick higher. So it looks like inflation is bottoming out at much higher levels than what we've come to expect in the past. Now, to me, when I look at the Australian market and I think, well, is it justified given what we're talking about with the unemployment rate right now beneath 4%, rollicking employment growth, productivity over the course of the last year going backwards by 0.7% on an hours worked basis? To me, it's jumping the gun saying that we need to go and cut rates really aggressively in this environment. Yes, economic growth has been slow of late relative to historic norms, but when you look at some of the details behind that particular productivity story and you look at some of the demand side coming through from areas of the economy, it still looks like there's risk there to the upside when it comes to inflationary pressures. And when you go and translate that across to what market is thinking when it comes to the outlook for Australian interest rates beyond the OIS curve, really interesting to go and see what's happened in response to the latest labour market survey here in Australia. This is 3-year ACBG futures, and you can see here on a daily basis, after a relentless run higher over the course of the past month or so, we've had this big reversal pattern, an evening star pattern. If it closes at this particular level, you can see here it's stalled out at the 200-day moving average, and then this big move in response to the labour force survey today. We have this uptrend coming through here. Yes, we're approaching the contract roll, so there's got to be a little bit of caution here. I've adjusted this particular chart to go and account for the contract roll. But you can see here big volumes going through. If this particular intersection here, this uptrend and horizontal support at 96.15 was to give way, then we're talking about the 50-day moving average and then 95.99. And that points to increase in when it comes to interest rates and the like. Now, it doesn't necessarily mean that's going to go and be an automatic boost to the Aussie dollar and the like, but that's something you go and keep in mind right now. It looks like the 3-year futures, which are very, very susceptible to shifts in interest rate expectations, are now starting to go and tell a little bit of a story themselves. Maybe, just maybe, the market has got a little bit ahead of themselves when it comes to the prospect of a rate cut as soon as February. Have a fantastic day. I'll catch you next time.